Hi, this is Vijay Bambwani, and in this video, I'm here to talk about why the bond yields have created such a furor in the markets and why equity markets got the shivers last week thanks to the bond yields. But first, I want to answer a few questions that my viewers have concerned and expressed concern over the video that I recorded yesterday titled Beware the Ides of March. There has been a slight act of omission on my part, and I apologize for that. I had recorded a video in the end of 2019 giving out a calendar, month by month and quarter by quarter calendar, wherein I had said that the end of every calendar quarter, the mutual fund industry pushes up the NAV, and the March ending quarter is the most bullish of all because this is the financial year end and the mutual funds are really very aggressive in pushing up stock prices. So March end is a time when you should not short sell. Some viewers were not clear as to the video titled The Ides of March was talking about bearishness or bullishness. So let me tell you that my view of March end being propped up by the mutual fund industry to window dress or gravy cover their NAV, that view still remains. What I just told you about was that the amount of stacking, the over leverage or the super leverage that you can take in your trades will come down sharply in the month of March because money will be a problem to get by. It will be difficult to raise money being the end of the financial year. Everybody is basically paying off loans, cleaning up their books of accounts, shrinking the size of their balance sheet, and therefore traders might just trade a little less. This was triggered in part by my own experience. I run a limited company that trades for a living. Yesterday, I had to top up my margin account because we simply could not make do with what we had given to the brokers because like I admitted in my previous videos, unashamedly admit that I stack. Intraday leverage is something that we use when the brokers are giving it without charge. We definitely take it. We press on the accelerator to supercharge our P&L accounts on intraday trades. So I decided to record a video for my viewers and friends to tell them that this is something that can happen to you. Money will be difficult to come by, and yet SEBI is asking for higher and higher margin amounts thanks to lower super leverage. For example, from the 1st of March, you have an intraday leverage of 2x. That means you pay for one lot and you can take exposure of 2 lots intraday. But from 1st of June, it's going to go down to 1.33. That means you pay for 10 lots and you can only take leverage of 13 lots intraday. And from 1st of September, it will become 1:1. You can only trade as much as you can pay for, right? That was the purpose of recording the Ides of March video. Of course, the mutual funds will do the magic that they do on every quarter end, especially March end, because this gets them the assets under management. So friends, let's dive into the next topic. Why did the bond yields create such a big furor? You see, if you were to go in a horse carriage, a Tonga or a Victoria or whatever you want to call it, you will realize that the horse is made to wear blinkers. In Bambaiya Bhasha, in Hindi, it is called Ghode ka chashma. It is not actually a chashma, but these are blinkers so that the horse can only see forward and it does not get frightened by the amount of vehicular traffic on the roads, otherwise it will stop pulling the carriage. Most of the traders that I talk, and I have trained thousands of them, are wearing blinkers in the market when it comes to their trades. They don't see the world view and the pull and push on prices that is coming from other asset classes that they must. Do you know that equity markets in terms of turnover are the smallest? The largest are forex markets, which are 100 to 200 times bigger than equities. The second largest is the bond market, which is the fountain of all the money. It is the source of the money supply, which is 50 to 70, maybe even 100 times, depending on which country you're talking about, bigger than the equity markets. Then comes the commodity markets, which is 20 to 50 times bigger than the currency market. Now, if you're going to be focused only on equity markets and you ignore all the other markets which have a definitive pull and push on equity prices, my friends, I'm sorry, but you're wearing blinkers on. And what happened in the bond markets was, now this is the place where Mr. Richie Rich and Mrs. Richie Rich invest their money. These are the big ticket investors who move the needles and gauges in the markets. Now, unfortunately, the MMT or the modern money market theory is telling us that negative interest rates are okay, zero interest rates are okay. Have you asked the guy who's writing the check if he wants to take negative interest rates? That means he wants to pay the bank interest just to keep a fixed deposit. I'm sure the guy is not amused. So what these guys started doing was to sell off the bonds that were yielding poor yields. What were they asking? They were asking for higher yields. Now you've seen Robinhood traders rebel against hedge funds and bringing some hedge funds down thanks to their trades in GameStop. You've seen the Wall Street bets or the Redditors come and attempt an abortive silver squeeze. So it was only a matter of time before the guys who write out the big checks started asking higher interest rates. What happens when interest rate goes up? The cost of money goes up. When the cost of money goes up, the cost of doing business goes up. When the cost of doing business goes up, and people like me who are professional day traders and professional stack traders know that trading is also a business. You have to take care of and account for each and every input cost. And money is also a cost. Remember, in the rising span margin scenario, I will need to put more and more money in the market to be able to take the same amount of positions and intraday leverage that I was taking 6 months ago. And if the cost of money is going to go up, either I will reduce my exposure in the market or I might even be forced to sell deliveries to raise cash. This is something that savvy investors who think about tomorrow, day after, 6 months and 1 year down the line read the writing on the wall, that rising interest rates are going to make money more expensive and therefore trading more expensive, which is why the bond yields sent shivers down the spines of the market last week. In the month of June, my memory is a little sketchy, it could be June or it could be July, 2019, I had written an article on Equity Master. It is still there in the archives, titled, "What are the bond markets signaling to us?" I had written as early as mid-2019 that the negative to zero interest rates are not sustainable and there will be a time when the big ticket check writers will start demanding more money, more interest rather, and that is when you will see shivers coming down to financial assets. So friends, what you are seeing right now is a tug of war between big money and the central banks giving out very poor interest rates. This is a very, very interesting time to live in. This is history being made. You're seeing Brexit. You're seeing the small guy, thanks to Robinhood and Reddit, humbling the hedge funds. And I'm keeping an open mind about anything can happen. But what I'm sure about is that volatility is going to go up, number one. Number two, the amount of money that I will require for trading will also go up, and therefore entry barriers or the hurdles that are to be crossed before you can become a successful day trader will become increasingly higher. It will become increasingly difficult to succeed at trading. So may the best trader win. I wish all my viewers a very, very successful trading career ahead, but do note that it does not pay to wear blinkers on your eyes. Take a 360-degree worldview. Each and every asset class has its own pull and push on the other asset classes, and you can only ignore the other 3 asset classes to trade in only one asset class at your own peril. Let's stay sharp, let's stay wise, and let's win. On this cheerful note, I'll bid goodbye to you, but not before reminding you, if you're watching this video on YouTube, please subscribe to my YouTube channel if you haven't already done so. Click on the bell icon to receive instant alerts about any fresh videos being put up out here. And in the comments section, do let me know what you think of this video. Help me reach out to fellow like-minded traders by referring my video to your family and friends. I wish you have a very, very profitable day ahead. Vijay Bamwani signing off for now. Thank you for watching. Take care. Bye-bye. Also, do not forget to subscribe to my free email newsletter, Fast Profits Daily, and get my free guide, How to Trade Markets Like a Pro.